Greetings, everyone. Thank you for joining us today for our webinar, High Cost Lending in Canada, Risks, Regulations, and Alternatives. We're going to get started, and we hope you'll grab a warm cup of tea or coffee, or perhaps something colder, depending on your weather in this part of the country today. We ourselves are coming to you from a bit of a rainy, windy day in Toronto, so we hope that the weather against our windows here will not give us too much background noise during today's presentation, but we'll do our best to manage our sound quality for you today. Just some quick logistics before we get started. If you're familiar to viewing webinars, you'll know all this already, but for anyone who's new, we have all audience members on mute today, but we definitely want to hear your questions. So if you can find the question panel in the side panel of your screen, if you think of a question during the presentation today, please type it in and we will be happy to get to it during our Q&A period at the end of the presentation. We definitely want to do our best to get to as many questions as possible. Everyone registered for today's webinar will receive a copy of the slides and a copy of the recording within a few days. So certainly if you don't receive it, please let us know, but you should automatically receive that within a few days. And finally, please follow us, follow along with us, and tweet to us if there's something you really hear that's really interesting to you today. Please tweet at us. We're using hashtag #ProsperWebinar for our webinar series, and you can find us at ProsperCan. Just a quick note about who we are. At Prosper Canada, we are Canada's leading champion of financial empowerment. We work with businesses, governments, and various community groups and organizations to promote and develop policies, programs, and resources to foster the financial prosperity of all Canadians. My name is Glenna Harris, and I work in learning and training here at Prosper Canada. We're pleased to bring this learning session to you today. A big part of our work is ensuring Canadians have access and knowledge about safe and affordable financial products. And we certainly see today's topic on high cost lending to be very relevant to this conversation. So we're very happy to be bringing today's webinar to you today. Just a quick look at our packed agenda for today's presentation. We're going to be looking at high-cost lending products in Canada and what that means and the challenges these kinds of products present for us working in the financial empowerment world. We'll look at how these products get used and what can be done about the challenges they face, or the challenges faced by consumers who engage with them. So you'll hear about some examples to do with payday loans in particular. When we think about high cost lending products, there are many different products that are involved in that category of product, but payday loans are certainly one of the most commonly known. And then we'll look at some multi-sector solutions and advocacy solutions to engage with these. And then time for questions at the end. So this is what we'll be spending our time with you in the next hour. So we look forward to it. I'm pleased to introduce to you our presenters. Courtney, Hare, and Jerry Buckland have both worked on this topic for quite a while, and we're excited to welcome them today. Courtney Hare is the Public Policy Manager at Momentum in Calgary. Momentum is a community economic development organization. Courtney leads the public policy team, which is dedicated to identifying root causes of economic exclusion and addressing system change. Her key research and policy areas of focus are currently high cost credit, children's education savings, local investing, and other poverty reduction strategies. So you can find her on the web on LinkedIn and find out more about Momentum online as well. Jerry Buckland, is an international development professor with the Canadian Mennonite University's Menno Simons College in Winnipeg. His research includes the study of financial resilience and structural inclusion. With colleagues, he is beginning a new research project called the Canadian Financial Diaries, and I'm sure he's going to tell us a little bit more about this today. And he's also working on a new book called Payday Lending in Canada, Global Perspective. That's going to be out soon in 2018. So we're going to get things started today with Courtney, and she's going to tell us more about high-cost lending products and what we mean by them. So I'm going to turn things right over to Courtney. Over to you.
Thank you, and thank you so much to Prosper for hosting us today. And it's an honor to co-present alongside my mentor and guru, Jerry Buckland. So real pleasure. Thanks everyone for joining. So what are we talking about today? We're talking about those cash stores with the neon lights that are open long hours, usually in lower income neighborhoods or major traffic corridors, and they have friendly staff and welcoming advertising. We're talking about payday loan stores, rent-to-own stores, installment lenders, title lenders, pawn shops, auto lenders, and check cashers. Basically the places that people go when the banks say no. And there are many synonyms for this type of harmful financial product and service. Some people refer to it as fringe financial, others high cost credit, and alternative financial products. But whatever you call it, these are services that are expensive and unsafe. And they are often the only option for low-income individuals or people with no credit or bad credit, or people who are unwelcomed at mainstream financial institutions. And this is obvious in their advertising. So on the next slide, you can see that they say things like, have you been recently laid off or in between jobs, not a Canadian citizen or permanent resident? The Loan King does not deal with credit bureaus or credit companies. So we know more about payday lending as these shops are licensed in most provinces, and we know much less about all the other types of stores that I mentioned, because many are not licensed. Now, these lenders are generally regulated provincially through various fair trading or consumer protection acts, and federally through the criminal code, sort of, and sometimes regulated municipally. So we have a patchwork of rules and licensing and regulation across the country that's not entirely clear. And we know little about their overall economic impact or the total dollars drained from families or communities. But here's what we do know. We do know that they are expensive, that the cost to borrow from these lenders is astronomical, and in some cases criminal, so actually above the criminal code maximum rate of borrowing. So take rent to own, for example. Rates appear to be affordable at first glance, particularly when you compare the upfront cost of an item. However, the cost is typically 2 to 3 times the retail price. So Easy Home lists a MacBook Air at $39 a week, which seems so affordable. But at the end of your rental term, you pay more than $5,000 for that laptop, the same laptop that retails for under $2,000 at the Apple Store. We also know that inadequate disclosure is a major problem. The total cost of borrowing is usually unclear to the borrower. Optional fees are not always presented as such, and insurance is often included automatically, though it is optional. And rent-to-own stores often present home delivery as a free service when there's actually a charge. We also know that these lenders lend to very vulnerable borrowers. There's often little to no assessment of a borrower's ability to repay. And for some individuals, a loan is not a good idea. And many borrowers would be better served through basic needs assistance, credit counseling, debt consolidation, or any other type of community support. We know that these lenders can be aggressive in their advertising. Borrowers report a significant amount of direct soliciting to reborrow, borrow more, and to sign up friends and family. And we know a bit about economic leakage. Not only are these businesses detrimental to the financial, mental, and physical well-being of residents, they also detract from efforts to alleviate poverty in lower income areas. And when high-cost lenders cluster in neighborhoods, they drive away more desirable business or prevent those that do exist from thriving. And lastly, we know that they are prolific. Canadians spend $260 million each year now on rent-to-own products, many of which are essential items like mattresses, fridges, and laundry appliances. And according to Equifax, high-cost installment loans now represent the second fastest growing type of debt in Canada, a 7.7% increase in 2016. And installment lending accounts for $132 billion owed in Canada. And there are over 200 Easy Financial locations and 100 Easy Home stores across Canada, and their shares gained 21% in 2016, outperforming almost all mainstream lenders in Canada. So that's a bit of an introduction of what we're talking about here today. Back to you, Glenna.
Thanks so much, Courtney. Those rent-to-own products that you were talking about there, can you maybe explain a little bit more about what a rent-to-own service looks like? You gave the example of a MacBook Air. So do these stores look like regular stores? How does it work when a customer purchases something on a rent-to-own service?
Yeah, the idea is that you will lease a product with the goal of ownership, and term lengths can vary. Ownership is often not achievable, and so somebody can spend months and months and months paying towards a washing machine, for example, only to have that washing machine repossessed and all their investment gone. So we've seen this often with momentum participants, spending 2 to 3 times for a product that then eventually is repossessed anyway, leaving them in even a tougher spot than they were before they rented to own.
Okay, so this could result in a problem situation for a couple of reasons, not just for the cost, but if they don't actually retain the product that they've supposedly purchased in the end.
That's right.
Well, that's a fabulous introduction, Courtney, and I want to turn things over to our listeners now, because we have a couple of polls to ask you to share some information with us. Those of you who are serving frontline clients, can you tell us just yes or no? Have you worked with clients recently who have used high-cost lending products? Just a really quick sense of if this is a familiar issue for your clients or no. So we'll give you about a minute altogether. We've had about 30 seconds on the clock so far. So just another half a minute and we'll collect our responses and see what your world is like in supporting clients with this issue. So another 15 seconds and then I'll close the poll. All right, thank you for your responses. I'm going to share the results here. Looks like 86%. So the vast majority of you have worked with clients who have used high-cost lending products in some way. So Jerry and Courtney, that's a real strong indicator that we're speaking to a very interested audience about what kinds of solutions and what kinds of things we can do to work away at this. I'm gonna now go to our second poll, which is to tell us a little bit more about what kind of products you've seen client support in your work. For those of you who do support frontline, and on this one you can click any that you have had some kind of support with. So a payday loan, a rent-to-own product, and an installment loan are the 3 key ones. But if there's any other one that we haven't thought of, if you'd like to indicate that, and maybe even type in the question box what other kinds of products you've seen clients having issues with. So I'll give you about 20 more seconds to respond to this one. All right, about 5 more seconds. Any last folks who want to click an answer? All right, I'll close this one. Looks like our results here are telling us that payday loans are definitely the most common. And Courtney, like you were saying, payday loans are often the most common first product that we think of with this kind of category of products. So that's certainly borne out in these answers. And then the installment loan is the next most popular, followed by rent to own. And then we have about a third seeing other kinds of fringe high cost products. So thank you everyone for these for answering these. This really gives us a good sense of the kind of world that you're engaging with in terms of client support and the kinds of products that people are using that they need help with. So thank you for your answers there. So Courtney's brought us through an explanation of what these products are and what they look like. And now we're going to turn things over to Jerry Buckland, and he's going to tell us a little bit more about how the world of high cost financial products, came to be a reality, what's happening in the world that has made this situation that we're looking at now. So Jerry, I'm going to turn things over to you for the next few minutes.
Okay, thank you very much, Glenna, and thank you, Courtney. I wanted to first of all say a little bit about what Glenna was saying in terms of maybe some underlying processes at work that maybe helps to explain the rise of high cost lending and fringe banking in general, and then focus in on payday lending a little bit more and say a little bit more about payday lending. And so to start with, on the next slide, I have a quote from John Caskey, who's sort of a pioneer in terms of investigating fringe banking in the United States, where I think it sort of took off, certainly payday lending took off before it came to Canada. And I find this quote quite instructive. If the poor must pay more for basic financial services, this increases material hardship associated with poverty and makes it more difficult for the poor to raise their economic status. And I really like this quote because I think it points to two dimensions to the phenomenon of high cost services or fringe banking. And that is that it presents a high cost for a person to do basic transactions at that point in time. And Courtney was explaining about the high cost of different types of financial services. So at that point in time, it presents a hardship in a sense relative to what a person might pay at a mainstream bank. And in addition, there's a dynamic effect that over time, the barrier that this person is facing day after day, transaction after transaction adds up, it accumulates, and makes it more difficult over time dynamically for a person or household to improve their financial situation. So I think it's really important to kind of keep in mind these two, both the static and the dynamic process. So then if I could, go to the next slide where I wanted to talk about financialization. And so financialization is a process that's been around, I think, for many years. And I think that it's pretty much accepted in the academic literature that this is a phenomenon that's happening. And the debate in academic literature is not so much whether it's happening or not, but why it's happening, like what's driving it. For the purposes of this presentation, I don't really want to talk about the whys, but more focus on the what. And so the what, to begin with, a common definition of financialization is that it's financialization is the growing integration of financial motives and the proliferation of financial devices in the socioeconomy. And so in the next slide, I have a graphic that tries to sort of conceptualize this. So on the kind of supply side, which is the orange colored circle on the top, we have more both non-finance companies and finance companies that are generating revenue from financial products. And so there's this growth in the reliance on the part of companies to generate revenue from finances. And then on the bottom yellow circle is representing the demand for financial products. And so on the demand side, we have both other companies that are demanding financial services, as well as, and this is the focus of our conversation today, consumers who are demanding financial products. And so I would say that the rise in the motives for financial services is generating that growing demand, and then the rise in the supply is coming from both finance and non-finance companies. Although because we're focusing on consumer finance here, the focus is primarily on finance companies. So in the next slide, what I provide is a very simple table that just points to one piece of, or one indicator that points to the rise of financialization all around the world. So financialization is probably furthest along in rich countries, but it's happening in poor countries as well. So if you look at the second from the bottom row, you'll see the high income countries are listed there. And what this table looks at is the financial system deposits to gross domestic product as a percentage. And you see that from 91 to 2011, the proportion increased by about 25%. And so this means that a greater share of finances are being captured by the financial system in the form of deposits. And in other regions, you see similar kinds of growth, but from a much smaller base. So again, it's an indicator of the growing importance of finances in our economy. It's just one indicator, and there are many other indicators. But the phenomenon of financialization, I think, is there's some very strong indications. So what I'd like to do now.
So
go
Jerry,
ahead.
I just wanted to pause because I think this is really exciting, and I think you're bringing in a lot of really interesting, global data in this one. And I guess so. If I'm understanding what you're saying correctly, it sounds like it's almost like there's more financial products out there of all kinds of different sorts of products, and because there's more products, we also continue to demand more products, and it's kind of like is this sort of like a cycle that goes back and forth?
Yeah, that's right. It's mutually reinforcing, and it's sort of a carrot and stick question, like where did it start? It's not that clear. Did consumers demand financial services, or did companies supply financial services? And probably it's a bit of both. And so the two are mutually reinforcing, and we see that among low-income people, low-income financial consumers and fringe banks, that we see the rise of fringe financial providers partly is driven by shifting the financial service provision from the informal sector into this sort of semi-formal fringe bank sector, and it's also shifting financial services from mainstream banks into this semi-formal fringe sector.
And like you say, the fact that there's more of these products being oriented towards low-income consumers, that's been a really recent shift, is what you're saying?
Yeah, like for instance, in Canada, we've had a few different fringe financial providers that kind of predate payday lenders. But the principal things that they were offering were check cashing, and I think rent-to-owns have been around for quite a while. But that's it, really. So what's happened since the payday loan was introduced in the late 90s, early 2000s in Canada, it's grown rapidly. And as I'll be talking about, in a minute, I'll be talking about how payday lenders have really increased the number of financial services that they're offering.
Okay, thanks, Jerry.
Yeah, okay, so let me then go on to talk about payday lending. And actually, I find this sort of an interesting slide. I checked Google Maps, and this is still on their street level view of the Department of Finance office building in Ottawa, where at least at that point in time, and last time I visited Ottawa, the Cash Money, which is a payday lender, was located on the first floor. I don't know if it's still there, but I find it quite interesting, such a juxtaposition. And so payday lending, as I mentioned, has kind of grown out of the check cashing sector and began in the late 90s in Canada and grew quite rapidly in the 2000s. And as Courtney mentioned, the payday lender charges a fairly high fee for their products to provide a 2-week loan. And the 2-week loan is repaid either by a personal check or by an automatic debit agreement that the customer provides at the beginning. And payday lending has been, since 2008, regulated by the provinces, or by most provinces, and this was through the action of the federal government, which created an exemption to the criminal rate of interest for provinces that established the payday loan regulations. And so most provinces have regulations. And in the next slide, I put together some data on one facet of that those regulations, and that has to do with the cap that's placed on what payday lenders can charge. So there's a few different features to what is involved in payday loan regulations, including disallowing things like rollovers, as well as limiting the repeat lending. In some cases, there's features like contributions to a financial literacy fund. And one of the maybe most prominent features of these regulations has been placing a cap on what payday lenders can charge. And so you can see for the seven provinces that we've got up there, you can see the cap that the payday loan regulations range from $15 up to $25 per $100 loan for a 2-week loan. And I wanted to add a few points there. First of all, we don't have the equivalent number for Quebec, because in Quebec they have a usury law that disallows loans that are in excess of 35% APR. Now, another point I wanted to mention is that sometimes people confuse the rate cap. For instance, the rate cap in Ontario is $18 per $100 loan for a 2-week loan. Sometimes that's confused with an annual interest rate. And they think, oh, $18 per 100, that's 18%. Hey, that's not bad. I have to pay that for my credit card if I take a cash advance on the credit card. Well, no, that's not correct. The $18 per 100 is for a 2-week loan. To annualize that, we need to use some kind of formula. The most common formula is the annual percentage rate, or APR. And so what I've done on the right-hand side of that slide is shown the APR equivalents for the different rate caps by province. So you can see that the APRs range from 456% up to 760%. So that's really the number that I would argue is the more appropriate number to compare to other kinds of credit products, whether it's a credit card or a credit line or other types of credit products. So this reinforces a point that Courtney made earlier, that the payday loan is a very expensive credit product. And if I could just go to the next slide. Another interesting feature of the payday loan industry is that it's quite a sophisticated industry. So here's another quote. This is from Robert Aitken, who's written extensively in this field. Payday lending now forms global chains, which are capable of extracting value from the edges of the financial system and drawing value back into the very core of financial markets. The payday lending sector is not a mom and pop sector. In the early days, there were some small payday lending shops, and there still are some, for instance, in Manitoba, but the lion's share of the payday loan market is controlled by large businesses. And one business in particular, that is National Money Mart, is a very large subsidiary of a very large international corporation. So payday lending is actually a very mature industry in the sense that they've got an important financial product that has grown rapidly in the 2000s. The growth in Canada has declined. I mean, it's not growing, but it's holding its own. although I was very interested in folks' responses to the question and the 72% who have found installment loans a feature of their clients' finances. And that's actually another aspect of the maturity of this industry, that payday lenders are moving into installment loans or have moved into installment loans, depending on the jurisdiction. So they are mature in the sense that they're large, they're mature in the sense that they have many different products, and where they see maybe a decline in profit or demand for one product, they're able to come up with another product where there could be greater profitability or greater demand. So there are many services that a payday lender offers. And in some ways, the term payday loan isn't really that accurate. They're really more of a multi-purpose fringe bank, but payday loan company seems to be the name that sticks. Another feature of payday lenders is that, and certainly National Money Mart has a very sophisticated corporate structure. So National Money Mart, I mentioned, is a Canadian subsidiary of Dollar Financial Group, and DFC Global was, unfortunately for us academics in Canada, was purchased by another American company that no longer is required to submit its annual report to the U.S. Security and Exchange Commission. So since 2014, we haven't been able to get as much information about DFC Global and National Money Mart. But we do know that it is a very sophisticated large corporation. And the final point there is that this sophistication has enabled the payday lenders to have a global reach. And often we think of the global reach as beginning in sort of Anglo-American countries, so that would be the US, Canada, Britain, Australia, New Zealand. However, we're seeing now the reach going beyond that into Eastern Europe, South Africa, and other countries. So there is another layer to that phenomenon, the global reach. Okay, so in the next slide, what I want to do is actually the next series of slides is just to speak a little bit about the structure of banking in Winnipeg and Toronto. I have more slides on Winnipeg just because I've done more work here, but we, with colleagues, have done some work in Toronto as well. So the next few slides look at sort of the distribution of mainstream and fringe banks in Winnipeg and then in Toronto. So here's the first slide, which is looking at the payday lenders that are in the inner city, which is the orange, and the suburbs, which is the green. So what you see there, sort of two interesting points I would highlight, that the growth in payday lenders really happened in the early 2000s, and since then there's been a decline. And the orange is pointing to the inner city, which is where the bulk of Winnipeg's low-income population live. And then you see the green starts to increase later into the mid to later 2000s, and that's the suburbs. And this isn't to say that payday loans are directing towards middle-class suburban markets. However, part of their services certainly are, but it's to say that payday lenders have diversified their location in Winnipeg, and we find them in both inner city and suburban locations, but disproportionately in the inner city. Another point I wanted to make from this slide is to note that the numbers of payday lenders has declined since 2008, and that was the point when regulations were put in place. Manitoba in 2008 implemented its regulations of payday lending, which included a rate cap of $17 per 100 per two-week loan. That was the lowest in the country at the time, and what it did was it led to the closure of certain payday lending outlets, as well as consolidation. I want to emphasize, though, that you see that there still are a number of payday loan outlets in Winnipeg, so clearly the regulations have not disabled the industry. It continues to operate, and arguably what's happened is the consolidation has increased the volume of payday lending in the smaller number of surviving outlets. Okay, so then in the next two slides, actually, I look at the distribution of banks, credit unions, and payday lenders in Winnipeg in 1990 and then in 2009. And here is the slide from 1990, and you can see the red dot in kind of the center. That's the only payday lender that we could find in 1990. And whereas you can see the blue being banks and the green being credit unions are quite well dispersed. And if you look at the inset picture on the bottom right hand side, you can see that there's quite a dispersion, or sorry, there's quite a density of banks and credit unions in the inner city. And of course the inner city includes the downtown, which is a whole different and important region as well. And the one payday lender, the red dot, is in that inner city area. So if we go to the next slide, we see some fairly dramatic changes. So this is in 2009. And what we see here is quite a large number of red dots. So as we saw with the 2 slides ago, the rise of the payday loan outlet, we see more red dots in the inner city and more red dots in the suburbs as well. And we also see, and maybe it doesn't come out as well in this slide, but a decline in the number of bank and credit union, pardon me, a decline in the number of bank branches in the inner city. And actually the next slide will highlight that point more clearly. So here what we see is a slide that provides the number of outlets or branches for payday lenders, credit unions, and banks in the inner city and suburbs in Winnipeg from 78 to 2009. And you can see that the line that's dipping dramatically is the mainstream banks in the inner city. And so, you know, 1978 there were just over 90, and by 2009 there were under 40. So the big drop there is the number of banks in the inner city. The number of banks in the suburbs has stayed roughly the same. And if you look at credit unions, they've performed, I mean, in terms of numbers in the inner city, much better than the banks. So they've tended to hold their own over time in Winnipeg's inner city. And then again, what we see from 2000 is a growth in the number of payday lenders in both inner city and suburbs. So that's just, you know, some more information about the distribution of payday lending in Winnipeg. And so then the next slide is my final slide. And sorry, it's kind of boring, but I just wanted to highlight some key points from the research that my colleague Wayne Simpson and I did in looking at mainstream banking and payday lending in Toronto. And so we did some similar analysis in Toronto for the years 1981 to 2006. And some of the key points were that mainstream financial institutions have migrated to the suburbs, away from the low-income neighborhoods, and fringe financial institutions, especially payday lenders, have expanded their operations in the inner city. So some similar results to Winnipeg. Moreover, we found that census tracts with low income, are less attractive to mainstream institutions over time and more attractive to fringe institutions. And we finally concluded that the location of financial institutions in Toronto present an additional barrier to upward economic mobility for inner city residents. So that kind of concludes my part of the presentation, and I'm going to pass it back to Glenna and Courtney. Thank you.
Thank you so much, Jerry. That was really, it really brings it home to see the map, I think, of seeing how that clustering happens in, like you say, the inner city and less wealthy neighborhoods. If there's more payday lender outlets, then you know, if those are the ones that are growing, then probably those are the ones that people in those neighborhoods are more likely to access. So that's thank you for bringing those research examples into it, and we look forward to hearing more of your work. I suspect you're doing quite a bit more based on your upcoming publications.
Yes, thank you very much.
So thank you very much, Jerry. I'm going to turn the rest of the presentation over to Courtney, and she's going to talk about the kinds of actions that are being taken primarily at the regulation and the advocacy level. So Courtney, over to you.
Thank you. That's great. Thanks, Jerry. And so we both shared with you some serious concerns about the industry and its impact, particularly on vulnerable financial consumers. And so, yeah, now I want to move to what's being done and what can we do. So Jerry mentioned that the explosion of high-cost credit is a relatively new phenomenon. And so now consumer advocates and governments are catching up. We've seen action taken across all sectors in Canada. So nonprofits, charities, consumer groups, academia, government, etc. So I'll share a little bit about what's happening in each sector. So with nonprofits and charities, we've seen more and more research and conducting advocacy on this issue, and several agencies have shown great leadership. I'm sure many of you that are participating in the call today have been involved. And we've learned from and worked with the Consumer Council of Canada, Options Consommateurs in Quebec, Acorn Canada, the Canadian Centre for Policy Alternatives, Prosper, of course, United Ways in multiple cities across our country, Credit Counseling Canada, and many others. And of course, Momentum. It's been a concern of ours going on 4 years now. In academia, no one understands this issue as well as Jerry Buckland, but there are others who have now joined him in researching this issue. Gail Henderson at Queen's University, Jennifer Robson at Carleton University, Mohammed El Hazzouri at Mount Royal University, and others. Now, government in particular has been quite active in this area, specifically provincial governments. In addition to cities such as Hamilton, Toronto, Calgary, and others. So Ontario, Manitoba, Quebec, BC, and Alberta are the provinces that have taken the most recent action on this issue. Alberta introduced an act to end predatory lending last year and has just concluded formal consultations on consumer protection and high-cost credit. And we are expecting some bold regulatory changes on high-cost credit this fall. Manitoba's Consumer Protection Act and High-Cost Credit Products Regulation came into force in September of 2016. And it provides, as Jerry mentioned, provides a definition of high-cost credit products and requires lenders to be licensed, pay an annual licensing fee, as well as an annual financial literacy support levy. And Quebec introduced Bill 134 in May of 2017 to modernize the Consumer Protection Act and outline new rights for consumers. And it includes licensing requirements for high-cost lenders and requires lenders to assess a borrower's capacity to repay a loan and introduces new restrictions on advertising. British Columbia and Ontario have also recently consulted on this issue, and we believe changes are imminent, so we're watching closely as to what's happening there. And then on top of the provincial and municipal movements, we've seen that the Federal Ministry of Finance is currently reviewing the Bank Act. And there are opportunities to address part of this issue through the Bank Act. Now, so speaking of the financial services sector, the mainstream financial services sector, we have seen the creation of some alternatives, particularly through credit unions. So Desjardins and Van City were two of the first to jump on this issue and create a more affordable alternative to payday lending. Here in Alberta, Connect First Credit Union created what they call the Cash Crunch loan, which looks just like a payday loan, but it's an interest rate of 19% and a term of up to 18 months. Our provincial bank, ATB Financial, has created some very unique partnerships between the bank and some payday lender, which is controversial to say the least, but some very interesting movement in the area. But we've so far, in my view, seen nothing major or meaningful from our mainstream banks. And I would say that this is unlikely unless we mandate it through the Bank Act. The community sector, so community associations, business revitalization zones, they've been voicing their concerns about these types of businesses and what types of businesses they actually want to see in their neighborhoods and their networks, and typically not more fringe lenders. And we've seen consumers and borrowers work to grow their financial literacy, taking courses, reducing debt, and arming themselves with the knowledge and the how-to. And so we recognize that there's no panacea for addressing the issues that we identified earlier, but a large part of our work at Momentum is around advocacy for regulation and better consumer protection. So in my next slide, I'd like to share with you some policy recommendations that we've been working on. We've just published in a report that you all will have access to following the webinar today. And so I'll share with you sort of our top 5 recommendations. There are many others to explore in the report as well. So first being lowering the cost of borrowing, including lowering the criminal code maximum rate of borrowing. So 76 countries have identified an interest rate cap for loans across the world, and many of these rates are lower than Canada. Canadian organizations have been calling for a lowering of the criminal interest rate. I've seen 30 and 36% most commonly. And a private member's bill was just introduced in March of this year, aiming to reduce the criminal code rate from 60% currently to the Bank of Canada's overnight rate plus 20%. In the US, there are growing calls for a 36% interest rate ceiling, and they've already been able to achieve that specifically for military families. Our next recommendation is to address what I described earlier as sort of this patchwork of consumer protection and regulation across our country. So hosting a Canada-wide consultation on high-cost credit and consumer protection in order to review, share best practices, and strengthen our lending laws, and to address the intersection of federal, provincial, and municipal protections. Third, we want to improve disclosure by mandating a financial facts label. So similar to nutritional labels found on food packages, a financial label is a standardized box that displays critical information about a product and its costs. And that way consumers can compare financial products across the marketplace with their true annual costs. So if you're looking at buying a car, you could look at a car loan, you could look at a line of credit, and you could look at any of these fringe lenders and be able to see what the true cost of borrowing is for each of those types of loan products. And lastly, we are interested in improving access to safe and affordable credit through banks specifically. So a review of the financial or federal financial sector framework is underway right now, with changes expected in 2019. And the formal consultation hosted by the feds just wrapped up, but you have the right to speak to government at any time. And so I would encourage you to submit your comments to the existing feedback channel, which I've shared with you on this slide, or to the Minister's office directly. We believe that banks are well positioned to offer safe and affordable alternatives to high cost credit, and that we must call for this change to the Bank Act. So I invite you to read all of our other recommendations that are in the full report, including other provincial and municipal recommendations. I invite you to read it, to share it with your colleagues and government, and to continue to provide us feedback as we work to evolve and address this issue.
Thank you so much.
Back to you, Glenna.
Yeah, thank you so much, Courtney. That's a really wide range of recommendations you've provided, and I like how you broke that out into, you know, there's different kinds of solutions that can come from so many parts of Canada and so many different different groups of people working in Canada. So this really can, so much voice and action can come through so many different sectors. So I really like the way you broke that out, and I think I really especially like the way you have this example of the financial fact label, in plain language. It's so true that this, helps us understand things so clearly, and wouldn't that, make a bit of a difference if we had that clarity when signing up for these kinds of things. So we'd like to invite questions. If you've been thinking about something throughout the presentation, or if you're, maybe just now thinking about things like the policy recommendations, or things like the geographic issues that Jerry was pointing out to us, the clustering of different kinds of storefronts in your neighborhoods, or even just the kinds of things you think about when you're supporting your clients day to day with different kinds of financial concerns. Courtney or Jerry, I'd like to start out with, because I think maybe this relates to some thoughts that many of our frontline partners have. If you were looking to a better alternative financial product for these kinds of clients, what would that look like? What do those better alternative products do that is different from a payday loan, say, but is also not the same as a mainstream bank product? What do those kinds of products look like?
I would first say that it's important to acknowledge that a loan is not a good idea for everyone. And so we often hear people share the importance of access to credit for all Canadians. But a major issue with the fringe financial industry is the lack of responsible lending and lack of assessment of a borrower's ability to repay. So at the same time that we're asking for banks to create alternative, more safe and affordable alternatives, what the banks have been good at is saying no to people that they think won't be able to repay the loan. What we're asking them to do is to analyze those metrics and to ensure that there are credit rebuilding opportunities for people to, while at the same time, maybe relax who they're willing to lend to, but also to make sure that it's going to be a product that promotes financial stability and not erode it. And so when I think of alternatives, I do think of mainstream banks playing a role, but I also think of anything but a loan. And so connecting people to resources and supports that address income insecurity in the first place. So that could be policies as big as basic income, to other and existing forms of social services support that can help people with bridge financing, to help them to be able to afford whatever it is that they need today that's a need.
Okay,
and
so
if I could jump in,
yeah, Jerry, absolutely. I was just going to ask. Yeah.
Yeah, I totally agree with what Courtney said in terms of different kinds of financial products offer different kinds of have different purposes, and focusing exclusively on lending is not a good idea, because loans have a particular purpose, and savings has a purpose, transactions have purposes, and so we need to find that product balance, and I fully support what Courtney said. The other thing I'd like to add is I'm concerned that banking is, with the growth of the fringe bank sector, there's different tiers, and the tiering of banking, I think, is problematic. So we have mainstream banks, and they're offering financial services that are particularly directed to middle-income people, and then we have fringe banks that are offering financial services that are more directed to low-income people. This phenomenon concerns me because I think it can reinforce that dynamic process I was talking about earlier, and aggravate poverty and accentuate income inequality. So I think where we have a tiering of banking, I think that's a problem. So to answer your question, Glenna, I think it's really important not only what Courtney said, to get the balance right between savings and credit, but also to make sure that mainstream banks take on their responsibility, which they have, partly because they're a regulated oligopoly and they have tremendous resources. They have a responsibility to provide banking services to all Canadians. And if we bifurcate banking, what happens is we have, a very expensive transaction-oriented services associated with fringe banking that make poor people pay more. And that's just not an effective system, I think, for an economy that needs to be efficient and fair.
Yeah, I think I would agree with that as well, Jerry. Thank you for those extra comments on that one. We had a couple questions come in around pawn shops. Do you know, either of you, are pawn shops, do they fall under these same kinds of regulations and lending practices? Would you consider them a high cost credit service as well?
Well, pawn broking at the provincial level, although in some cases there are municipal regulations, and so where there are municipal regulations, they tend to have more to do with preventing the sale of stolen goods. So police monitor items that are pawned or brought in for secondhand sale. So typically they don't regulate interest rates, although that's not the case in Ontario, where I believe there is regulation on interest charged. But what happens there is that companies have sort of risen up to get around the regulations, and rather than calling it a pawn loan, they call it a resale loan or some other. There's some other term that's used. So the regulation of the pawn sector is fairly scattered, mixed. I should say one thing about pawn brokering. And that is that they do face some substantial storage costs, insurance costs that are different than the payday lender. So it is a different business model. The outcome for the borrower typically is fairly high cost loan, although in Manitoba, for instance, the APR on a pawn loan is lower than the APR on a payday loan.
Okay. Okay, so we also had a couple questions following up on the regulation for this sector, and I think, as both of you have drawn attention to, this feels like a real patchwork of regulations and rules almost. Do you think there's an ideal way to approach regulating these kinds of services?
I think there are a number of best practices that we can draw from across Canada. So in our own research, we did a lot of inter-jurisdictional analysis. So learning from the different provinces, but also looking around the world. Jerry is well connected to some of the work that's happening in Australia, which is impressive. And so what I'd love to see is for all of us to get in the know and get in the know-how to best implement some of these consumer protection framework. So licensing, for example, is what I would call a best practice, and many of these products and services are not licensed. And so we want to make sure that all of the provinces and jurisdictions across Canada understand what are the opportunities and benefits of licensing, what are the best ways to go about doing that, and licensing being just one simple measure. There are a plethora of other ways that we can look at improving consumer protection, and let's do that together.
That's great.
And if I could just jump in too, sorry.
Yeah, please do.
The other thing, like as an academic, one of the things that really helps me to do my work, which is to understand how people are affected by, in this case, financial services. One of the things that would really help me is if the regulators collected information, data from the fringe bank companies that they regulate. And this doesn't mean proprietary information that would somehow undermine the company's profitability, but information that can help us to understand, how is this product benefiting people? There are jurisdictions in the United States that do collect this kind of information, and I think Canada, we are behind in that process. So sometimes, questions that we think about in terms of impact and benefit, often we can't report very effectively. The other thing I'd want to mention is that I would say that as we, if there is a harmonization and an increase in regulation of fringe banking, there needs to be a counter sort of regulation of mainstream banking to ensure that there's not a vacuum created. In other words, if fringe banks are somehow better regulated and their product supply diminishes, I would want to make sure that mainstream banks are stepping up so that the products that they're providing are increasing.
That's a really good point, Jerry, because as you say, the and Courtney, I think you've drawn out as well. The fact is that these are kind of these are people who are looking for some kind of lending product anyway. And so if there is not that sort of fringe service, then what is the alternative, and how can we make sure that that there's a solution in place? So I think we've come to the end of our session today. It's now 2 o'clock, and I put up this last slide here because we had a couple questions come in asking more about the range of rates that these kinds of products cost. As we said before, this is the example of the cost of a payday loan, typically for 2 weeks. Across the country, this does have quite a range. So as Courtney and Jerry have done such a great job of sharing with us, there's different kinds of solutions that can happen across policy and across community action and across everyday Canadians asking questions and pushing for change from their corners of the country. So I really want to thank Jerry and Courtney. You've brought such a great presentation to us today with so many different aspects of this world that I think we have now learned is more complex than we might think at first glance. So thank you, Jerry and Courtney, for sharing your knowledge with us today, and thank you everyone on the line for sharing your time. We know your time is valuable, and we want to thank you for spending your hour with us today. As we said, you'll be able to find a recording of today's webinar and the slides for today's webinar in your email within a few days, but you'll be able to watch the recording as well from our webpage in our resources section once it's available. If you have any questions about what we've talked about today or anything else to know about what we're doing at Prosper Canada, please be in touch. We have email, a website, and we have our newsletter that we hope you will subscribe to, because we always put a whole batch of information in there about what we're working on and upcoming events like today's webinar. So please keep in touch. We hope you'll follow us on our social media and join us for our next webinar series events, which will be coming up more later this fall. So again, thank you, Jerry and Courtney, and thank you, everyone.
Thank you very much.
Have a great day, everyone.